Hello friends, here we are going to learn the various methods of national income accounting. As we know that national income accounting means we are trying to account or keep the records of all the income generated within the domestic territory of an economy. So let's start that what are the various phases of circular flow of income, because whatever the income has been generated, that has generated due to the production taken place in the economy. Whenever a production has taken place in the economy, factors of production will be required. Factors of production, and these factors of production, in against of their contribution, they get factor payment. This factor payment is a type of income for these factors of production. The income earned by these factors of production will provides them the purchasing capacity, and due to this purchasing capacity they demands money, which cause expenditure flow. The production taken place, that comprises production flow, and due to the contribution of these factors in the production flow, it cause income flow, and income flow will cause expenditure flow, because the income flow provides purchasing capacity to these factors of production, and this expenditure flow again cause for further production in the economy. That's why the circular flow of the economy goes through three phases. Production flow, income flow, and expenditure flow. Due to these three phases of circular flow, we can measure the economy at any stage, either at production flow, at the stage of production, or we can measure the income generated due to the production taken place, or the expenditure that has caused in the economy due to the income earned by these factors of production. That's why the national income can be calculated by any three stages, or all these stages of circular flow of income provides one method of national income accounting. That's why we can say the methods of national income accounting are first production method or value added method or output method. All these three names are of one single method, that is production method or value added method or output method. Now the first thing is how we can calculate the output method or so the value of output can be measured by price of 1 unit of goods which are produced multiplied by number of unit produced. So the number of unit produced and the price of 1 unit of goods, this will gives us the value of output. Now when we have to calculate value added, we have to deduct value of output minus intermediate consumption. This will provide us the value of output, value added. When we deduct the value of intermediate goods from the value of output, it will gives us the value added. Now still we have just calculated the value added out of the gross value of output, because gross value of output means still the value of output is including the value of consumption of fixed capital. That's why whatever the value of output we have calculated, it is gross in nature. That's why whatever the value added we have got, it is still showing the gross value added at market price, or we can say it is gross domestic product at market price, because still we have calculated only the goods which are produced within the domestic territory. That's why it is gross domestic product at market price. Now we have got GDP MP, which is the gross value added at market price, which is as similar to the value added, because the value of output was gross in nature. This was gross in nature. That's why the value of value added was also gross in nature, and that's why it is the gross value added at market price. We can also call it gross domestic product at market price. Why it is market price? It is market price because we have taken the price of 1 unit of goods, which is the price in the market. or the price at which the goods are offered in the market. That's why it is the price of one unit of goods which is being offered in the market. That's why it is GDP MP. Now when we have to calculate net domestic product at market price, or we can also call it net value added at market price. If we have to calculate NDP MP, then what we have to do is we have to deduct the value of consumption of fixed capital or depreciation. Because why it was in gross in nature? Because it is still including the value of consumption of fixed capital. When we deduct the value of consumption of fixed capital, that is depreciation, from the gross nature, it will become net domestic product at market price, or net value added at market price. Now the identity of national income is NNPFC. So when we have to convert this NDP MP into NNPFC, we just need to convert this D into N and this MP into FC. Now to convert this net domestic product at market price, and this one is net national product at factor cost. To convert this domestic into national, we have to add net factor income earned from abroad. Along with that, we have to convert this market price into factor cost. Market price, which includes indirect tax and subsidies, along with factor cost. That's why we have to deduct indirect tax and add subsidies. The net national product at factor cost will be calculated. Now, as we have seen that the value of output provides us price of one unit of output into number of unit produced. This will gives us the total value or total revenue received by the economy in the accounting year. It is the total value of revenue received by the economy in the accounting year, which can also be called as sales. So in production method, when we apply, we get GDP MP, gross value domestic product at market price. It gives us the total revenue received by the economy in an accounting year, which can also be called as sales. Whatever the goods has been produced in the economy, it is not going to be called as the revenue of the economy in the accounting year. It comprises the sales. It may be possible that some output can't be sold out in the economy in that accounting year. That's why sales, along with all those goods which are not sold in that particular year, we can call it closing stock, and excluding the opening stock of last year. The opening stock is the closing stock of last year, and this closing stock is the closing stock of current year. So closing stock minus opening stock minus intermediate purchase, that is intermediate cost. We can also call this closing stock minus opening stock. We can also call it change in stock. So we can say sales plus change in stock minus intermediate purchase. Here sales includes sales to household, sales to government, sales to other firm, and export. It may be possible that all these items gives separately in the question. You just need to club all these sales, which will gives you the total value of the sales of the firm or the economy. As like that, the intermediate purchase comprises purchase of raw materials, second purchase from other firm, third purchase from the rest of world, or we can say it import. So when we club all these intermediate purchase or all these purchase, it will gives you the total value of intermediate purchase. That can be the value of this intermediate purchase can be put in this formula, and by this way we will get GDPMP and our question will be solved. Because when we calculate GDPMP by deducting depreciation, we can get NDPMP, and by adding NFIA and deducting net indirect tax, or by deducting indirect tax and adding the subsidies, we can find the value of NNPFC, that is the national income of the economy.